Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
We start in the back with A, B, and C. The record of predictions since February that the price of crude wouldn't get out of hand is being challenged. But having looked at all the news in the last 48 hours or so, I think that be a settlement sometime before Sunday. And I think the settlement is going to allow some type of Iranian supervision of both channels. Apparently, there are three channels. There's one along the Iranian coast, which they, want people to register to use. I don't know whether they always want to collect a tolling fee. Then there's a channel along the other side of the straits, along Oman. That is referred to as the South Channel. And it looks to me like based on what I read, that the U.S. effort was to keep that clear so that the Iranians could run their channel, let's call it the North Channel, and the U.S. and Oman could run its channel. Now, what happened was there were a series of shuttle tankers going from out in the Indian Ocean through the South Channel to Saudi Arabia, Iraq, picking up oil, bringing the oil back, and then offloading it to ships out in the Indian Ocean. Those shuttle tankers are generally Greek owners. They're probably not as well insured from a voyage point of view as would be ideal. But I think what is happening is the Saudis, the Iraqis, or the Abu Dhabi is in effect self-insuring the cargoes. Those are the ships that Iran put drones into, or I think in one case, an anti-ship missile. And what has happened is the Greek owners do not want to run that anymore, even though there hasn't been any significant damage to any of those ships, but they don't want it. There was some fatalities, crew in one case. I think two crewmen died. And so the Greek owners have said they're not going to do that anymore. So effectively, the South Channel is closed. Now, to give an idea of the impact of these shuttle tankers, a lot of them are VLCCs, which means they hold 2 million barrels. If the amount of oil running through the strait to kind of keep Asian markets supplied, if you move 5 ships a day through, that's 10 million barrels. That, I think, had the oil market fairly relaxed. As those shuttle tankers decided even with U.S. protection, they weren't going to do that. Now you have Brent up in the 90s and WTI in the low 80s. I think the only solution here is to have the U.S. and Oman agree that there'll be a combined supervision of both channels, and maybe that will create another ceasefire. If I had to guess, something like this will happen. It's now Wednesday afternoon. I'd be surprised if something like this hasn't been agreed to by halfway through the weekend, but we'll see. In the meantime, if you look at the bottom of paragraph, bottom of Exhibit B, oil's pretty elevated. And it's much higher in the near month than it is out in 12 months from now. That's called backwardation. And the backwardation is just an assessment by the people participating in setting the price and buying and selling barrels 12 months from now, that there will be some accommodation. And I think the market is right. In terms of gas, disappointing. You can see that 27 price is now 340. The table up above has an estimate for 27 to 350. The supply is not really the problem. I would say the problem is demand, and it's not LNG demand. If you look at the table on Exhibit B, LNG demand is pretty robust. The shortfall is making power with gas, and that is on the flat side. If you go back and look, it was up significantly each year until 25, and 25 is down from 24. 26 is up a little, and this projects that 28 will be up a little bit. With all the publicity about data centers and relying on gas-fired power, the fact is that gas to make power has been on the flat side. What is happening is that during the Biden administration, and even before, a great deal of tax incentive was set forth or made available to encourage wind and solar. And this has happened all over the country. For example, there's more wind and solar in Texas, a very Republican state, than in any other state. So these projects are coming on. Now, they don't provide dispatchable power because solar doesn't happen to wind, the wind can't stop blowing. So it provides a lot of electrons, but it doesn't provide capacity. Companies like independent power producers like Constellation, Vistra, NRG, none of these companies are on the 20-page memo. They made quite a good living by selling capacity. In other words, the 7-day-a-week, 24-hour-a-day capacity. So that market's been very strong. But the price of natural gas, this today, next week, next month, 12 months from now, goes up and down with the price of power, the spot price for power, and it has been weak. Exhibit A, I saw some of the testimony by the Defense Secretary and the Chairman of the Joint Chiefs on why they need $1.5 trillion of spending in defense in the next fiscal year. They make a good case. You can see on Exhibit A slotted this in at 1.2 trillion, and hopefully the deficit holds in the 1.5 trillion range. If it doesn't, the timing's uncertain, but we will have a problem. We will have a failed treasury auction or something. But if they can somehow keep that deficit to the 1.5 trillion level or slightly lower, I think we'll get through 26 and 27 without a capital markets event. So that's, I think that the largest spending is, if you look down the column, is kind of shared between Social Security, which is pretty much off limits, and Medicare. And of course, defense, Medicare and Medicaid is $1.8 trillion. Defense is scheduled to be or estimated to be $1.2 trillion. And then interest is $1.15 trillion. There isn't too much we can do about interest, but the place that change needs to happen will be in that Medicare, Medicaid. But we'll see if they can keep it at $1.5 trillion and show a little bit of decline in deficit spending. I think they'll get through the remainder of 26 and 27 without having a capital markets event. But that's certainly something to focus on. Mike, Jason, anything else to add or correct?
No, I think that was a good summary.
All right. Yeah. We're going to look for value for the next few weeks in these companies. And last week, in kind of an unrehearsed, none of these podcasts rehearsed, but really unrehearsed, Mike and Jason on page one made the case for Amazon and Alphabet because they're so strong in infrastructure. In other words, providing the cloud capacity, the compute, it's going to be more is going to be required, especially as people adopt more use of AI language models. And I think the reason they picked Amazon and Alphabet rather than Apple or Microsoft or Tesla or SpaceX is the largest in providing this kind of infrastructure is Amazon. Microsoft with Azure is second largest, but of course they have the Office suite and other things that may be impacted by AI, but Alphabet has been increasing their capability here, their backlog and their revenues and whatnot. So depending on how they will be closing the gap between them and Azure, the Microsoft operation. Just before we leave page one, and we promised to get to the back pages too, but Mike, Jason, anything else noteworthy on page one in terms of in a very pretty elevated stock market looking for value?
Quickly, I would just say that depending on for the infrastructure as a service providers, if the model is relatively commoditized and there's more demand than supply, then the value should accrue to the infrastructure providers. If the model's commoditized and there's plenty of compute for everybody, then the value should accrue to the application. So for now, it seems like that middle scenario is what's happening. We had a Kimi K3 model came out recently, a handful of other very high-performing models that were not released by OpenAI or Anthropic. And that basically means we're getting closer to parity amongst the models. So infrastructure will become in higher demand because the cost per token for these tokens that come off the open source models will be lower. And really, I shouldn't even say cost per token, but the cost to do a particular job will go down, which means more jobs will be created, essentially, more digital jobs. Yeah, we're still pretty confident in that position.
Yeah. Just as a diversion between the three of us, the one who really knows security because of his past career is Jason. Jason, we're a corporate user. Let's say we're, I don't know, a bank. Say we're JP Morgan. What do we really think about Chinese open source models and risk to security of information, proprietary information? Can that be managed?
Oh, absolutely. I think the model itself is just a list of weights, which means it's not even software. It's a library that someone's going to plug into their software that they provide to the customer. In this case, maybe JP Morgan. So it's not capturing user data. It's just a black box where you ask it a question and an answer comes out. So the creator of the model is not going to capture anything you put into it. Now, what we've seen with Anthropic is in Fable 5 is they've decided they want to capture that, and they've changed their terms of use where they're going to capture the data that you put in through their software layer. They're capturing it, not necessarily Fable 5, the model itself capturing it. So all that's to say is it matters where you run the model. And you can run a Chinese open source model in a US data center with a trusted party hosting it and be safe. But you really need to know the terms of service that party is delivering the software to you under.
But Jason, what about the other side? So now that this capability is open sourced, you have to also defend your systems against potential attackers that have very good tools.
That threat's going to be there no matter what. You can't stop that. It's the open source models are coming. OpenAI and Anthropic would like to stop their models from being used in an adversarial situation, but you can't stop any of the others.
Well, and as we saw with the Hugging Face hack incident just over the last few days, that was I guess, an OpenAI test to see how their system worked. And what it did is it basically jumped around and hacked their partner, really, at the end of the day. And I guess when Hugging Face tried to defend against it, the model it was using, I forget if it was an Anthropic or an OpenAI model, but it basically was nerfed because there was a risk of that they were violating the terms of service. So I feel very strongly about this, that we cannot have the government step in to regulate who can have what model. You just have to let the market take care of the solution.
Yeah, I think it was very self-serving that their model went out and hacked
Yeah,
Hugging Face.
It almost seems like it was set up, but yeah.
I think Anthropic and OpenAI are arguing for regulatory capture. If they're doing that, I don't see how there's not some moral obligation that they have to go and essentially hack every bit of software out there. They don't have to, once they get in, they don't have to do anything malicious. They don't have to steal files, but let everyone know, here are the vulnerabilities and correct them. Because the other side, their models are being distilled by the Chinese or anyone else, even US companies, and they will be used in this manner. So to say that no one should do it doesn't, someone's going to do it.
It would be an interesting way to deal with open source if you had some sort of a collective system that would check and validate all the open source stuff as new versions are pushed out.
Yeah, make sure there are no vulnerabilities.
I'm going to leave page 2 to next week. I don't think I can talk any of the three of us into software now. All these companies on page 2 have a significant software business. Page 3, standout company here is NVIDIA, and I would say Taiwan Semiconductor. Both of these companies are extremely strong with a lot of free cash flow in NVIDIA, a lot of CapEx at Taiwan Semiconductor, but I was just fascinated. I'm sure a lot of people on the phone, certainly Mike and Jason, saw an interview with the CFO of Taiwan Semiconductor, and they said they were going to expand significantly. They talked about having a total of, I think my memory is correct, $200 billion invested in Arizona in time, that Arizona was making significant progress in making, advanced chips, that they were going to expand. And the CFO of Taiwan Semiconductor, perfectly comfortable speaking in English, said, "We don't want to leave any food on the table for others." I mean, he's talking about Intel and Samsung and Teradata, which is must sell. These two companies are just standout companies. Who knows where the right value is? I mean, NVIDIA seems expensive in terms of where it's been in the past, but it's not a very big price earnings multiple. And Taiwan Semiconductor, of course, you have the risk of a Chinese invasion or embargo or whatnot, but you could argue that AI wouldn't be happening with NVIDIA without the NVIDIA GPUs, but we can make an even stronger argument that none of this would be happening without Taiwan Semiconductor's capability to make the chips. Understated anything there on page 3?
I'd say that they set the pace, right? And that's what's important for them to maintain their lead, is that as long as they're the ones in production on the latest node, essentially the highest performance chips, they're going to command a significant premium for their wafers versus Samsung and Intel and anybody else that's behind. The worst case scenario for them is that they, in a sense, they're sort of a monopoly on the leading edge. The difference between a traditional monopoly is that if they under capacity the market too much, there's so much incentive from Taiwan Semiconductor's customers to get more chips that there will be a lot of industry support to replace them. And I think that's sort of what's happened over the past 12 months. It's why I think the stock's up 40% in Q2. Taiwan Semiconductors recognize that they need to spend more. And I think it's good that they're investing so heavily in Arizona. $265 billion is the total they've committed.
Page 4 is, again, something we'll come back to on future weeks. Basically, media. Netflix continues to go down. They were the absolute leader, and they've lost ground. We have Meta on this page. Meta's very interesting, but I think for next week, we never talk about Spotify, but we'll put that on the agenda for next week, I think. Page 5 is newer companies, Palantir, which has been in the news quite a lot recently, Kratos, who smallish company, relatively small company, very involved in missiles and drones and whatnot. Bloom Energy is, to me, kind of a question mark. It's gone up enormously, but it makes fuel cells, and the hyperscalers prefer the fuel cell. If they, rather than make power with a turbine, they'd rather make it with a fuel cell because there are less emissions. And of course, GE Vernova is the part of GE that makes all the power equipment. I, I'm not gonna answer anything on this page for value. I don't know about your case. It might say watch Palantir, but over to them. What are those two do you think?
No, I think you need a lot more growth out of Palantir, and you're paying for it at 100 times free cash flow.
Right.
So
Page 6 is telephones and Verizon, T-Mobile, Charter. We moved Charter and Comcast here because, in effect, they're all in competition to service your home and service your wireless. And I would say it's the opposite of a duopoly. It's really, my view, being a long-term Comcast stockholder, not understanding at all what they're trying to do, spinning out the content part of the business. I just view these 5 companies engage in destructive competition. Now, Mike and Jason know this area well because they had an interest in a company called Dish that they did okay with, but it was not for the faint-hearted. Any other commentary here, Mike or Jason?
the main thing is these companies tend to carry a lot of debt. You see the least amount of debt there on this page is T-Mobile. I think that works out as relative to their equity, and it commands the highest multiple of free cash flow. Charter is the example where they used to have a very high equity value, but the debt, especially after COVID, when they had to refinance into higher rates, affected their cash flow more dramatically. Enter SpaceX, you have more competition here. It's not as good a business as it was.
That's true. That is very true. SpaceX with their satellites is a real competitive threat, I think. Page 7, MasterCard and Visa have been two of the great companies known over time. I just think like software, they got some challenge. PayPal has a bid being made for them. Circle, I don't understand. I include it because it has a stable coin, and I thought that was interesting. But now, having gone through the 10K and the 10Q, I couldn't really tell you how Circle makes money. Any other commentary here?
I'd say PayPal and Circle make money the same way. They both hold dollars and they get interest. PayPal, your average customer, I'm going to cite this from memory, but I don't remember, but the average account has something like $20 of balance.
Right.
And it just sits there. So it's like the multiple looks very good as long as the interest rates are relatively high. And PayPal is probably the most interesting one on this page at 8 times when they had a buyout offer at nearly twice the price here. It's 43 as of this. I think the buyout offer was in the 80s. So it's interesting, but MasterCard and Visa are better businesses.
What's better value there? Page 8, the retailers. Walmart recently seemed really overvalued. Target kind of blunders from defeat to defeat. Lowe's, I've owned forever. It's been a fantastic stock. Pretty much a carbon copy of Home Depot. It's really a duopoly. CarMax was great for a while. Has a new manager and trying to change it around a bit. And of course, Costco is one of the great long-term investments. Also pretty expensive. Page 9, 10, 11, and 12 are the energy companies. That's my specialty. That's what I've done for the last 60 years. First as an investment banker, then I went to trade, became an investor. I think I'd just rather leave it till when something has worked out with Iran. I think the volatility in oil is got to be dealt with, as we talked about earlier. Page 13 is the financial stocks. I actually counted all 5 of them here. I guess you could say Interactive is expensive and Moody's is expensive, but it seems to me these are awfully good businesses. Their cash flow is really their cash flow. You can see, other than JP Morgan, which I did find what I thought was some capital spending there. I don't see any capital spending in Morgan Stanley, Goldman Sachs, Interactive, or Moody's. Moody's a little different. They're the ones that rate the bonds. Don't know how, given all the leverage and refinancing and whatnot, just seems to me that's a pretty good business. If you had to pick one of these to own, I think the best of them, the one that has the biggest moat, as Buffett Munger would say, I think it's probably Interactive, because their costs are so low relative to their competition that pretty hard to compete with. I keep saying Mike Jason. Why do I say Jason Mike? Anything else on page 13?
I agree with you with Interactive Brokers. Although we heard
It's
a
always
very,
gonna be-
very compelling pitch for Moody's recently.
We
Yeah.
did. Yeah.
Yeah, I think with all the debt that needs to be issued and refinanced, how are you going to do without bond ratings? So
It's a lot more expensive if you don't have a bond rating. So you're going to get a bond rating for sure.
Right.
Interactive and Moody's are both expensive. And I'm not saying rates of return on equity. I mean, JP Morgan, Morgan Stanley, Goldman Sachs, especially with these big IPOs, I agree with the two of you. Page 14, I have owned and loved Caterpillar. We use engines on our boats, especially the motor boats, throughout the energy business. There's very little in an oil field where you don't see Cat engines. They've had this big upswing. They're trading very, very multiple times free cash flow. And part of it is because, most of it is because they supply a lot of this power equipment. And just so even more than Jiva Nova. So the company that always kind of looks like a carbon copy of Caterpillar is Deere, but Deere's for farming, and Caterpillar's 40 some odd times free cash flow, and Deere's 20 times. You could say, well, I'll lighten up on Caterpillar and own more Deere, but I don't think that'd be a smart thing to do. Caterpillar is also a good business and very good at manufacturing things, which we're doing a lot of reshoring and trying to do things more ourselves. Caterpillar is one of the really outstanding businesses, designing and manufacturing products. Should be better than it is. I mean, most generally make a high portion of how we protect ourselves against the blackouts. TransDigm is just an overall good business that has been a good business for many years. Fastenal the same way, just an advertisement for doing this kind of investing. You have the presence of mind to buy Fastenal as IPO 30 some odd years ago. I think if you laid out, I think you bought 1,000 shares for $9 a share, you've now got $7 or $8 million of value, including dividends. So Fastenal is, you never see a Fastenal story. They are all over the place, supporting all things, manufacturing and construction, and so on and so forth. That does bring us to a health page. So we made it, page 15, which is the Pfizer page. So we're going to turn page 15 over to Jason.
Yeah, of this page, the cancer vaccine companies are pretty interesting. Moderna and BioNTech, of those two, I think BioNTech's been, as we've discussed, a lot more diligent with how they spent their money through the COVID years, a little more conservative with it, and that leaves them with a longer runway today to fund research. So we have a lot of hope for cancer vaccines in the near future, but BioNTech's in a better position to actually realize that without having to raise additional capital. We own Vertex. We really like Vertex's position. We think the recent acquisition is a good acquisition. If they hit the goals that they claim for Palsonify, which is the drug that the acquired company received approval for late last year, I believe, it would be a quite good acquisition. So big pharma, we don't really love the business model of really large pharma. That includes Vertex. But aside from them, like a Pfizer, where they're in a constant cycle on the hamster wheel of replacing their pipeline, replacing drugs that are falling off patent, having to do a lot of acquisitions, that's not a good place to be, despite what I just said about Vertex.
Vertex on the smaller side of big pharma, right?
Yeah.
I mean, they've grown there by being good capital allocators.
Yeah, they're allocating for growth, whereas Pfizer's in a playing defense, trying to replace revenue that's falling away.
I also noticed Pfizer's the only one with debt on this page.
Right. Vertex is medium pharma, not big pharma. Page 19, Jason. Since we're campaigning against Big Pharma, let's start from the right on page 19, which is Lilly, which seems to perform better than the others.
Yeah, they haven't put a foot wrong lately. They're winning the market for weight loss drugs and diabetes drugs. They are winning the market for the first generation of Alzheimer's treatments. They're really in a good position. That said, where the value is on this sheet, I tend to like Regeneron more. They have a lot of competition for their commercialized drugs today, but I think they're even trading at a lower multiple today. But they have they're really great management and a really strong pipeline behind it. So they've been repriced for the future where their two name brand drugs are not bringing in as much revenue as they are today. And you can buy the pipeline at a discount, where Lilly is not cheap. They've been riding the hype wave of the weight loss drugs.
Yeah, I seem to have been wrong about Lilly because I just figured you're going to have so many of these different options in weight loss drugs that the profits will get sucked out of them. But it's been wrong on many different angles.
It hasn't happened yet. Yeah. But there is a lot of this class of drugs in research right now.
Yeah. Well,
late stage research.
As Jason and I learned in our startup endeavors, that there's really no difference between being too early in a call and wrong.
We've made it all the way. Let's leave United Healthcare for next week. We've made it all to page 20, and there's a healthcare page company on page 20, Harrow, which Mike and Jason own and spent a lot of time pulling apart. So I guess the closing comments are yours, Jason, on Harrow.
Yeah, so they're coming off a low free cash flow amount today, and we expect that number to grow pretty significantly. And how they're doing that is they're in early stage commercialization of a handful of drugs and introducing a couple more this year, so this quarter and next quarter. And where they get leverage is their sales force can sell into ophthalmologists or into ophthalmology, into optical surgeons and with overlapping drugs. So an example would be they sell the topical anesthetic to numb the eye before you give an intravitreal injection, and that would be Regeneron's Eylea, for example, but Harrow is introducing a biosimilar so that they can co-brand that as a package, so the topical anesthetic and then the actual drug. So they're doing that in a number of different treatments.
Yeah, and so they've basically picked up, they provide more products to those practices than anybody else. And the main reason is the big pharma companies don't want to waste their time with these products that don't make much money. But as a result, nobody knows ophthalmology better than Harrow. Alcon would be like another very good one in that space.
And they've passed on purchasing the rights to some of these drugs because they were competing with an asset they already held in their portfolio, which is an interesting way to think about it. But now potentially better treatments are in the hands of Harrow, and they acquired it they were the only buyer essentially. So they had the leverage and they acquired them at a very low cost.
Yep. Sub-blockbuster scale drugs are very hard to market. So if you have that network, if you have the sales force that's able to service them, it's very unique.
Yeah. We're a little more over than normal, but had to get Harrow in. We will be also all over the 20 pages next week, and we'll focus in on software opportunities. For those there's a pretty good software article in last weekend's Barron. Read it, have it next week. It's worth looking at. In the meantime, we'll be here exactly 7 days. Everyone be well and stay healthy. Thank you very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, Neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.